After holding Realty Income since 2020, I finally decided to sell. But not for the reason you might think. Realty Income is a great company, no doubt about that, but my investing strategy changed. And today I'll break down why I made this move and where I reinvested the capital to maximize return. So stick around because I think that you'll find this shift interesting. But before that, let me know in the comments if you're holding Realty Income and for how long. I'm curious to know. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. Let's get this straight. I didn't sell Realty Income because it's a bad company. In fact, the opposite is true. Realty Income is a great company with a strong track record. They've been consistently paying dividends, currently yielding 4 to 5%, and they consistently increase these dividends for over 25 years. So why sell? When I started investing, I was all in on dividends. The idea of passive income from stocks sounded like the ultimate goal. But after 5 years of investing, my perspective shifted. While dividend investing is great, it's not the only way to grow your wealth. From dividend investing to dividend growth investing to value growth investing, I realized that I don't need to be boxed into one kind of investing strategy. So I've been stepping out of my comfort zone. I've been putting more resources into companies that I believe will provide more growth and value for me in the long run. Later in the video, I'll show you which companies are these, so be sure to keep watching. What about you? Do you prefer dividends, growth, value, or a mix of both? Let me know down in the comments. Another reason is I wanted to maximize my capital. I don't have unlimited funds to invest, so every dollar needs to work as efficient as possible. While Realty Income provides consistent dividends, its stock appreciation is slower than other opportunities. I kept evaluating my portfolio and realized that I wanted to increase my position in certain companies. The problem? I needed capital. This led me to make a decision, sell Realty Income, and reallocate the funds. Another supporting reason is tax efficiency and aligning my investment decisions with my goals. As my strategy evolved, I started paying attention to tax efficiencies. Realty Income dividends are taxed as an ordinary income, which isn't ideal compared to lower tax rates on long-term capital gains. Over the time, I realized that I wanted to focus more on stocks that provide stronger price appreciation while being more tax-friendly. My financial goals have also changed. Instead of prioritizing steady stream of income, I'm now focusing more on my portfolio's overall growth. Selling Realty Income gave me the flexibility to shift towards investments that align better with my long-term vision. Every decision that I make now is about optimizing my total returns, both before and after taxes. Okay, so here's where I reinvested that freed up capital. Starting with Amazon, which is a company that is a dominant force in multiple industries like e-commerce, cloud computing, AI, and digital advertising. My position currently sits at 54 shares with a total value of $10,000, and my current cost basis is $186. So why am I increasing my shares and my position in Amazon? First, AWS continues to be a massive growth driver. Amazon Web Services generated $28.79 billion in Q4 2024 alone, maintaining its lead in the cloud industry. Another key factor is advertising. Amazon's ad business grew 18% year over year. It generated $17.3 billion in Q4 2024, making it a serious contender against Google and Meta. On top of that, Amazon is making big moves in AI. The company is integrating AI across its platforms, including AI-powered logistics and the launch of Amazon Bedrock for enterprise AI applications. With multiple revenue drivers and a clear growth trajectory, adding these 3 points, Amazon's remain a long-term growth winner in my portfolio. Next is Alphabet. I own 53 shares with a total value of $8,000. Alphabet, the parent company of Google, is a powerhouse in tech and AI. I currently own 53 shares with a total value of $8,000. So, what makes Google a strong long-term investment? For starters, AI is a massive focus for the company. Google's Gemini AI is now integrated in Google Search, Google Cloud, and enterprise tools, directly competing with OpenAI's and Microsoft's ChatGPT. Speaking of search, Alphabet's core business remains unmatched. Google still holds over 91% of global search engine market share, ensuring a steady and reliable ad revenue. But Alphabet isn't just about ads. The company's cloud segment grew 25% year over year, and Waymo continues to expand its autonomous vehicle technology. Beyond that, Alphabet started paying dividends. The company is now paying 20 cents per share in dividends, showing its confidence in its financial strength. With over 110 billion in cash and cash equivalents, Google has the flexibility to invest in AI, cloud expansion, and new ventures without financial strain. Between AI, cloud expansion, and its advertising empire, Google is a long-term bet that I feel confident in. Next is Salesforce, or CRM. I own 23 shares with a total value of $6,000. Salesforce has been expanding their AI capabilities, and with the growing demand of cloud-based solutions, I believe that this stock has a lot of room to grow. And the newest member of the portfolio is Uber. I currently own 63 shares with a total value of $4,700. This is the newest addition in my portfolio. Uber is the biggest transportation network company in the world, operating in 10,000 cities across 72 countries. They serve more than 124 million users monthly and work with 4 million independent drivers. They've been growing fast, averaging 39.2% revenue growth over the last 3 years. In the past 12 months alone, the revenue jumped 18% from 37 billion to 44 billion. Right now, the company is trading below a 20 PE ratio, and based on its price to free cash flow, Uber is a very attractive company to invest in. Beyond ride-sharing, Uber is expanding aggressively. Uber Eats continues to grow, their freight division is scaling, and they've introduced an in-app advertising business that is already generating revenue. But there are still risks that I'm keeping an eye on, like regulatory issues, gig worker classification debates, and competition from Lyft and Didi. But Uber's ability to scale globally, improve margins, and capitalize on new technologies keeps me optimistic. Last September, Waymo and Uber announced a partnership to bring self-driving Waymo cars in Austin and Atlanta exclusively using the Uber app. Some sees robo-taxi as a threat to Uber, but I think that Uber is positioned to benefit from this shift. So, what do you think? Would you invest in Uber? Let me know down in the comments. That's a big shift in my portfolio, moving from realty income to high-growth companies like Amazon, Alphabet, Salesforce, and Uber. If you get value in this video, don't forget to hit the like button and subscribe to get more videos like this. And if you're serious about building wealth, I made a series about reaching your first $10,000, what changes after, and where to invest. You can watch it here.